Welcome to Skytech-Lens. On August 2, 2025, 7 of the world's most vital seaports abruptly halted all incoming shipments from the United States. This wasn't war or disaster, but a coordinated economic protest, a direct response to U.S. trade policies that had pushed global commerce to the edge. Wall Street plunged as panic swept through investors, reflecting the chaos unleashed by the shutdown. The move was a drastic measure, signaling that the global supply chain could no longer bear the costs of America's protectionist stance. Suddenly, thousands of container ships with American exports were stranded, and the economic pain spread rapidly. These weren't minor harbors, but the giants of global trade: Los Angeles, Long Beach, Oakland, Seattle-Tacoma, New York Elizabeth, Savannah, and China's Yantian. Their unified refusal marked the end of unfettered trade with the U.S., making the costs of a trade war real for millions. The day the gates closed became the moment theory turned into harsh reality. The August 2025 crisis was the result of an escalating tariff war led by the Trump administration. A 145% tariff on Chinese goods shocked global markets, sending costs soaring and trust plummeting. Even a temporary truce, lowering tariffs to 30%, couldn't undo the damage. Businesses scrambled, fearing the next policy shift. New tariffs on trucks and parts further destabilized American logistics and manufacturing. For port operators, these weren't just numbers, they were existential threats, making U.S.-bound trade unprofitable. The decision to halt shipments was a last-resort defense against unpredictable, crippling costs. The tariffs, meant as negotiation tools, instead shattered the mechanisms of global trade. By making trade prohibitively expensive, the U.S. pushed its partners to walk away. The silent ports in August 2025 were the direct result of this strategy. The port closures triggered a financial shockwave. Wall Street lost billions, and stocks in trade-dependent companies nosedived. The manufacturing sector was hit first. Auto plants halted as parts ran out, leading to mass furloughs and supply chain chaos. Tariffs meant to protect American industry instead paralyzed it, exposing deep global integration. For consumers, the impact was immediate. Imported food prices soared, and shortages became common. Moody's warned of 4 to 6% price hikes on the East Coast alone, as inflation crept into every container. The crisis revealed how interconnected the world's financial and logistical systems are. Delays in one sector triggered crises in others, freezing payments and breaking contracts. The halt in shipments created a domino effect, showing that no nation is immune to global disruption. The abstract idea of tariffs became painfully real in grocery bills and empty shelves. The crisis proved that in a global economy, isolation is an illusion. The ports of Los Angeles and Long Beach, handling a third of U.S. container volume, became ground zero for the crisis. After the 145% tariff hike, ship traffic dropped sharply, hundreds of thousands of containers vanished, and dock worker hours were slashed. Communities like Wilmington and San Pedro faced sudden, devastating income loss as trucking depots and local businesses emptied out. Even after tariffs were lowered, recovery was slow, shipping lines hesitated to return, and lost work hours weren't restored. The ports, once symbols of American economic might, sat partially idle. The damage to schedules, contracts, and trust couldn't be undone overnight. The economic engine of Southern California sputtered, with thousands of jobs at risk. The truce brought little relief. The scars of volatility lingered. The shutdown inflicted a deeper wound than any foreign competitor could. The ports stood as monuments to the unintended consequences of trade policy. The crisis spread nationwide. Seattle and Tacoma saw cargo volumes plunge by up to 40%, and trucking activity fell sharply. Oakland, a key hub for California's agricultural exports, faced canceled sailings and double-digit drops in traffic, leaving farmers with unsellable goods. New York and New Jersey's port throughput fell nearly 30%, threatening supply chains for millions and driving up consumer prices. Moody's warned of significant price hikes as shortages hit the East Coast. Savannah's strong numbers masked a frantic pre-tariff stockpiling. By June, traffic crashed nearly 10%. The initial surge was unsustainable, and the downturn exposed the fragility beneath the surface. Across the country, the ripple effects of the shutdown devastated local economies. The trade war's pain was felt in every port city, from the Pacific to the Atlantic. In China, the port of Yantian, handling over a quarter of U.S.-bound shipments, was hit hard by the tariffs. The 145% tariff made most exports to the U.S. unviable, forcing Yantian to join the shutdown. A brief truce triggered a surge in shipments, overwhelming the port, and causing severe congestion and delays. The chaos revealed the instability of doing business amid unpredictable policies. Even goods that made it onto ships faced delays, disrupting American production. When Yantian closed its gates, it symbolized the collapse of the world's most important trade relationship. The port, once a monument to globalization, now stood silent, a powerful statement of broken ties. Trade, it turned out, was a two-way street and barriers cut both ways. Behind the numbers, the human cost was staggering. In port cities, longshoremen lost shifts and income overnight, threatening families' financial security. Truck drivers sat idle, and the small businesses that served them saw revenues collapse. The pain rippled outward. Mechanics, diners, and logistics firms all suffered. Small and medium businesses, unable to absorb costs or pivot supply chains, faced bankruptcy. Even giants like Amazon and Walmart suspended orders, leaving shelves empty. The promise of reshoring manufacturing proved slow and complex, not a quick fix. Instead of a renaissance, the US saw shortages, price hikes, and industrial paralysis. Decades of global investment couldn't be unwound in months. The trade war's true casualties were American workers and families caught in the crossfire. With ports closed, businesses turned to air freight, an expensive, desperate alternative. Air shipping costs soared, creating a divide big corporations could pay, but smaller firms were priced out. Airports and cargo facilities were overwhelmed, unable to handle the surge in heavy goods. Backlogs and delays mounted, proving air freight couldn't replace maritime trade. The scramble exposed the limits of supply chain flexibility and the high cost of disruption. Tariffs meant to protect US industry instead, forced companies to pay even more for foreign goods. The sight of auto parts loaded onto planes became a symbol of the crisis. It was a costly, inefficient workaround for a man-made disaster. August 2025 was a harsh lesson in global interdependence. The US learned it couldn't dictate trade terms without consequences. Partners pushed back, not with weapons, but with economic power. The shutdown exposed vulnerabilities in just-in-time manufacturing and the illusion of self-sufficiency. Economic strength comes from integration and reliable partnerships, not isolation. Tariffs became real costs for businesses and consumers, not just policy numbers. The projected $1.2 trillion cost of tariffs was felt in lost jobs, higher prices, and shuttered businesses. The port shutdown stands as a cautionary tale. Global trade is a delicate ecosystem, easily disrupted. In an interconnected world, economic war is self-harm, and recovery is far harder than disruption. Thanks for watching. Subscribe the channel for more updates.